Hello everyone, James O'Reilly here with your Autumn 26 economic update. And boy oh boy, what an update it is. So much is happening in the world, so we're going to jump straight into this. Your normal general advice disclaimer, as always, feel free to have a good look at that one. Let's get started. There are no secrets that the Iran war, US-Israel-Iran war more specifically, is having a tremendous and tremendously negative effect on our economy. What you're looking at here is a graph of oil spikes in the 21st century, and what you can see very clearly is that this one is extremely pronounced, has been very, very sharp, and is far greater than anything else that we've observed for many, many years. This is having huge long-term effects on the economy, and hope that the sooner the strait can be reopened, the sooner some of those effects might subdue. But as it stands right now, with the strait still closed, this is a great source of concern for us. Why? Well, for two reasons. The first reason is that when we have higher energy costs, we see lower gross domestic product around the world, lower GDP, which very simply means lower output. Economies should be growing and thriving, and in environments where there is low output, they contract. Many of you might have heard the talk of a global recession, for instance, which is characterized as 2 negative quarters of growth. And what you can see here is that at the moment, we have positive growth, but in an adverse scenario or a worst case scenario for both 2026 and 2027, we see adverse and severe scenarios with substantially lower growth. Similarly, if we go over to this side and we look at inflation, we see that in both the adverse and the severe scenarios, we see that inflation is higher. And the biggest worry for mine here is around the long-term effects, the downstream effects of this war, because the real problem is not so much fuel costs today. It's the fact that if the strait remains closed, eventually it starts to wash through every corner of the economy. And when that happens, we end up with a really, really poor economic outcome across the world. This particular data is completed by the International Monetary Fund, the IMF, and the spokesperson who went through these slides, Julie Kozak, she stated that for every 10% sustained increase, so over 12 months, 10% increase in energy prices, you're going to see about 0.4%, almost 0.5% increase in global inflation. Now, if we jump back a few notches here, although we're not at 12 months in, we are well above a 10% increase in energy costs. And if this is prolonged, it is going to have meaningful, well over 1, potentially 2+% increase on inflation. What that means is that the cost of goods globally goes up, and not in a healthy way because the economy is thriving and people are spending money, and it just in a purely poor way, inflation is eroding the cost of people's finances. When that happens globally, we start to run into some big problems. Now, if we think about what this means from an Australian perspective, we need to look at our inflation data and also the cash rate. Many of you have seen a slide just like this one. It's a common conversation for us because it is so important in terms of your day-to-day finances and also investments. What you're looking at here, the yellow line here is the current cash rate of the RBA, and the black line is inflation. So let's go back a little bit. We saw inflation starting to come down. We had when we had COVID, we went into a negative quarter of growth, which was this period here, and then after that, we had a tremendously excessive and liberal tax cuts and funds and money going into the economy, and that absolutely ratcheted up inflation horrendously. The RBA said, oh my goodness, we've got to do something about that. So they started increasing the cash rate and making it more expensive. Your borrowed money, the long gone were the days of paying 1% mortgage or 2% mortgages and the like. We went up to 6%. We had this really rude awakening. We held there for a time. Cash rate came down as it did. Inflation came down. And when it went back into this range, the RBA said, okay, we're now ready to start cutting rates. As they cut rates in 2025 or late 2025, what we started to notice is that inflation was going up again. Australians were spending more money more confidently, and we were starting to move outside that band. We were sitting outside that band at 3.7% in the most recent the CPI data for the December quarter, and the RBA said that's enough. We are going to increase the cash rate again. We're going to make it even harder for Australians to spend money. We're going to tighten up cash flow, and hopefully we get this number back down again. So, of course, there is a strong relationship between the inflation and what your mortgage is, and by extension, the free cash that's in the economy. Australia is a net fuel importer. We are geographically freight intensive. We are car dependent. All of these things mean that we are very, very, very sensitive to what's going to happen to the price of Brent crude oil. Now, the Federal Treasury, like we've got inflation right now at 3.7%. Looking at the most recent Federal Treasury papers, all of their modelling was inflation peaking in between 4.7 and 5.1%, which is a big, big, big hike in inflation. And we know historically when we go up, when this number goes up into the the fours and the fives, we know that yellow line there, the cash rate is going to go up too. So even before this war, the January data was strong at 3.8%. February was quite strong at 3.7%. We get the March data on the 29th of April, so pretty soon. And that was the last data point that the RBA is going to get before they do they have their meeting on the 5th of May. It is currently priced in at about a 3-to-1 yes that they will increase rates from 4.10 to 4.35. So for most of us, we should be preparing for a higher mortgage cost from in May. And I'm sorry to say that if this situation continues and the Strait doesn't reopen very soon, we probably have to price in more than one. Let's move on. One of the other observations that we've had here, and a direct result of our situation and a flow-on of the Iran war, has been the AUD to USD chart. Now, what you're looking at here is a 1-year performance of the Australian dollar versus the US dollar. And the Australian dollar over the last 4 or 5 months has increased by about 10% against the US dollar, which is a really pronounced increase. Why? As Australian interest rates have increased, it makes investing, putting your dollars investing into Australian dollars more attractive because the rate of return is higher. So global investment increases. Conversely, money is leaving the US and moving to Australia. That increases the value of the AUD. There are some winners here. The obvious winners, as it says here, cost of all imported goods. Imported goods, the cost goes down because we're paying with AUD that's worth more. The second thing is that overseas travel costs. For those of you that are lucky enough to be traveling abroad, then you are typically paying less to convert your currency into whatever domestic currency you're in. And the Reserve Bank is actually a real beneficiary of this too, because if our imports are lower, at least that is somewhat offsetting the cost of higher inflation and probably higher mortgages and higher lending costs and so on. But there are some losers. The first one is all exports. If imports are better for us because the AUD is high, then exports are worse for us. Anyone who wants to buy anything in Aussie dollars is going to be paying more, and that's a poor outcome. The second one is Australian Stock Exchange companies with overseas earnings. If you're listed in Australia, but you're earning all of your money in USD, and the AUD is, of course, strengthening against the USD, well, the flow-on of that is that you're now earning less in AUD than you were before, despite the fact that your business operations are exactly the same. And the last one, and this is quite material for a lot of our investors, is unhedged international investments. Now, a lot of our investors have, not entirely, but a reasonable proportion of unhedged international investments in the form of ETFs that might predominantly invest in US equities and things like that. Now, if that is the case, then of course the AUD increasing by 10% is essentially devaluing that portfolio by 10% in real terms, despite the fact that the underlying performance of the portfolio might actually be exactly the same. The unit price could be identical, but it's worth less in AUD. We've looked at this really carefully. I don't think it's the time to jump at shadows here and take action, and I say that because I feel that when the Strait of Hormuz does eventually reopen, Australia, despite the fact that we'll have very likely higher cash rate than we have right now, we are going to see that start to come down. We see this as a short to medium term issue, and certainly not something that we want to that we want to leap to resolve. We trust that it will resolve itself. Similarly, headline inflation is increasing all around the world, and if we think about the US and the probability that in time they will increase rates too, or alternatively just a genuine flight to the greenback, which often happens once some of these issues are resolved. So Again, we're not looking at this saying that we need to do anything, but we are mindful that it is creating hopefully a short-term drag on portfolios. Well, let's keep moving. We're going to go to AI. AI has been has obviously a huge driving force of investment markets over the last little while, and it's creating some really clear winners and losers. The winners, companies focused on AI technology, of course, and IT companies, as it says here, that have strong proprietary data, embedded workflow structures, and regulated or mission critical systems which can't be replaced. They are all performing very well. But that said, the market is broadly downvoting potential AI losers, despite very wide-ranging impacts to each individual company. So many of these recently sold down companies have still have strong revenue and have the capacity to harness AI themselves for their own expansion. So IT companies that have predominantly performed really well because their user experience has been really strong, and so like we're best in market because our UX is great. They are companies that are getting hit because the investment market is arguing that you will be replaced with other products that have very high UX. You need to have, as it says here, proprietary data, your own data that actually meaningfully improves the value that you can add to your customers. Similarly, if there are software systems that are easily duplicatable, Xero in Australia is getting hammered here because the view is that in no time at all there will be a whole heap of very strong alternatives to Xero at a lower price point. And also low barriers to entry and low barriers to uptake. This is another area where typically those IT losers will exist. Having said all of that, our view on this one is that we still want to be invested in tech, and we still have a very strong belief that long term that tech is going to grow your portfolios. Obviously, it's creating a huge amount of turbulence in terms of the performance of technology, but we don't fundamentally think that justifies straying away from the technology sector. We have seen periods of rotation where the tech sector has been remarkably cheap, and we've seen periods where it's remarkably expensive. Right now, of course, we've come off the boil here, but fundamentally, if we're thinking about the next 5 to 10 to 20 years and where we should be investing capital, we maintain that investing in tech is a really intelligent play. I do acknowledge, though, that there is an implication here, I think, for a lot of these companies around future revenue per customer. In a world where it is much easier to build apps and it is much easier to build competitor products to a lot of IT companies, the byproduct of that is that perhaps those companies' views on how they were going to increase revenue per customer by perhaps increasing fees by 10 or 20 or 30%, that's going to start to get compressed, because the more they increase fees, the more their customers are going to look for viable alternatives. If they are available in the market, then that is going to be a problem. Let's go across to the domestic property market. This slide is via our good friends at Cotality, formerly CoreLogic. What you can see is we are seeing a really broad dispersion of returns across Australian domestic property. Over the last 12 months, Australia had very good property returns, around about 10%, 9.9. That was driven mainly by the regionals. The regionals outperformed capitals 11.7 to 9.3. But what is very unique about this is across the capital cities, which is these yellow bars here, just the tremendous discrepancy that we're observing from city to city. And it is quite rare in my experience to see the Australian property market performing, and the capital cities performing in such a polarizing way. Probably the biggest take from me, this particular slide here, or these charts were taken from the most recent monthly housing pack by Cotality, and it was this one here. This slide seeks to talk about how dwellings are performing based on whether they are top quartile, middle quartiles, or bottom quartile in terms of value. So let's pick on Melbourne. Melbourne has a median house price of around about $900,000 for simplicity. So we'll say bottom quartile is below $650,000, upper quartile is above $1.5 million, and everything between those is in middle quartile. What we're seeing here is that the bottom quartile, for almost all cities, the bottom quartiles are still performing quite well, ACT being the exception. It is the top quartiles that are being hit most heavily, that are underperforming versus the remainder of the properties in that city. Now, we saw this trend previously post-COVID. When interest rates started to ratchet up, we observed that the top quartile of the market was the one that got hit the most heavily. And intuitively, it kind of makes sense. You've got the top quarter of the market getting hit most heavily because interest rates are going up, serviceability is getting harder, and people's ability to buy the $2 million home has gone from requiring a household income of $300,000 to $370,000 because of higher interest rates. And I'm sure you can appreciate that significantly compresses the number of people that are there on auction day putting their hand up. It also creates some uncertainty. People that want to buy the $2 million home might be looking down the barrel of a $1.5 million mortgage, and they're thinking to themselves, how exactly are we going to fund this? Because if interest rates keep going up, it's really going to put us at a point where we can't afford the mortgage. We would rather wait until interest rates have stabilized. We feel confident that they're either going to stay there or go down. That's when we will enter the market. Unfortunately, this might be a trend that we see for a little while yet, on the basis that we're likely to see interest rates going up rather than down. The last thing that we want to go through here is the federal budget. This is on May 12, and there are some big changes that we are expecting to see in the budget. You will get a video of that shortly after that budget outlining exactly what the implications are. But just for your own expectations, Northeast, we are expecting a couple of changes here. Firstly, we expect the capital gains tax discount is going to be reviewed. We think that everything that we can read, it seems most likely that it'd be changed from 50% to 33%. It remains to be seen if that will apply to all assets or if it's just going to be concentrated on property. It also seems most likely that there would be grandfathering applied, i.e. if you have purchased property before this date, then you will maintain a 50% CGT discount. Otherwise, future transactions will be at a higher rate. The second one here is around negative gearing. Of course, there's a lot of arguments around negative gearing and whether or not it serves Australians. Broadly speaking, it seems, frankly, that it doesn't. As part of that, I expect that this is going to change. Our best guess is that grandfathering is going to be unlikely here, although it's not necessarily going to be something whereby they make it effective from right now. Much more likely is that they would start to phase out negative gearing circa FY28, FY29 and give investors an opportunity to rotate properties and let them go if they wish, or retain them. Having said all of that, there's also some confusion and some proposals here around maybe people should be able to negative gear their first or second properties but not their third. That proposal, it seems mighty messy to me, especially when you've got different entities and different options available. I would imagine that that's probably not the path they'll go down, just because administratively it'd be bloody hard to manage, but we will see. Imposing a minimum tax rate on trust distributions. This has been used to very good effect for a lot of people, business owners who are deriving income. It's going into a trust, and rather than paying themselves at highest marginal tax rate, they distribute to their family or to or elsewhere. This scheme does make sense. The idea of just making sure that we're not distributing money to a 0% income earner, for example, and getting a huge free kick here. So I expect that this is something that we're going to see. Hiking oil and gas tax revenue. If this happens, it's not likely to be grandfathered. Albanese has already indicated that we're not going to make any changes to any of the taxes that already exist on, for example, current projects. But the petroleum resource rent tax is well overdue for change. It has been for a while. We expect that there's going to be some changes here. The only circumstance with which they'd be held off is the view that energy is already in a state of flux, and we want to make sure we get this right, or we want to get the timing right. And the last one, EV tax changes. There's conversation around a road user charge for people who drive EVs to ensure that they are also contributing financially to the roads. Of course, that happens through the cost of petrol. About 50 cents of every litre in petrol goes to is essentially a tax that goes directly to road use. Whereas EV drivers, we're not getting that benefit, or the government's not getting that same benefit. Also, that fringe benefits tax exemption that's existed for for electric vehicles, when that scheme was introduced in 2021. I believe the expectation was that it would cost $55 million. It's cost $560 million so far. A tremendous number of Australians have realised how incredible an offer it is and decided to buy an EV. We expect that that's going to change very shortly. As a result of all this, what does all this mean? We think we're entering higher for longer inflation phase. We also think that there's an uncomfortable likelihood that the downstream effects here are going to be protracted, especially in Australia. Government policy may be delayed here, so to not exacerbate this pain, but we think there are very likely a few more interest rate rises. And importantly, we are now resetting our 5 to 10 year return expectations. They're already being adjusted in portfolios because we are seeing portfolio contraction. But we're mindful that if we are in a higher for longer state, then your portfolios need to adjust accordingly. There'll be more news shortly in terms of what we're doing with portfolios. You'll get that, I'd like to think, next week. And then we can act on some of those things. Hopefully we're in a position in the very short term whereby the Strait of Hormuz reopens, because that is ultimately the source of so much of this pain. Thank you, everyone. And any questions at all, feel free to get in touch with us or your advisor.